Imagine watching a once mighty supermarket giant scrambling to raise cash by selling off its own backyard. That's the stark reality facing Asda right now, as falling sales force tough decisions that could reshape its future. Let's dive into what's happening and why it matters. In a bold financial maneuver, Asda is offloading 24 of its stores along with a key distribution center, only to lease them right back into operation. This sale-leaseback strategy is set to generate a whopping £568 million, but experts are labeling it as a clear sign of weakness amid ongoing sales declines. For those new to business lingo, a sale-leaseback is like selling your house to a friend and then renting it from them. It frees up immediate cash, but commits you to ongoing payments, which can strain finances if things aren't going well. Headquartered in Leeds, this major UK supermarket chain is gearing up to unveil its latest quarterly earnings next week. Despite aggressive moves like slashing prices to lure in budget-conscious shoppers and sprucing up store layouts to enhance the shopping experience, Asda has been steadily losing ground to competitors. Think of it this way: while rivals like Tesco or Aldi pull ahead with innovative deals and faster growth, Asda's efforts haven't quite stemmed the tide. Digging into the numbers, sales dropped by 3.9% over the 3 months ending November 2nd, based on insights from World Panel by Numerator, previously known as Kantar. That translates to a full percentage point erosion in market share compared to the same period last year, a tough pill to swallow in the cutthroat grocery world where every shopper counts. The plot thickens when you look at the bigger picture. Asda's parent company posted a staggering loss of nearly £600 million last year. This was driven by shrinking revenues and skyrocketing expenses tied to managing a massive debt load, which acts like an anchor dragging down profitability. High debt means more interest payments, leaving less room for growth or weathering economic storms. Retail expert Clive Black from Shore Capital doesn't mince words. From an outsider's perspective, unloading these physical assets now screams vulnerability. He points out that while the influx of cash could help chip away at debts or fund fresh investments, like upgrading technology or expanding online services, it comes at a cost. Those new lease payments will eat into daily operational funds, making every penny count even more. If business was booming, this might fly under the radar, but it's not, Black adds. We'd hoped for steadier performance by this point, yet recent grocery market share figures are dismal. Everything feels precarious. And this is the part most people miss. In a healthy economy, such deals might signal smart asset management, but here they highlight deeper troubles. Echoing that sentiment, Patrick O'Brien from Global Data reflects on Asda's bold March announcement under new chair Alan Layton. The plan was to shake up the industry, with aggressive price reductions to claw back lost customers. Remember those headlines about battling for every cart? Yet, it seems the impact has been underwhelming. There was real buzz that Asda would unleash a pricing powerhouse, but it hasn't fully come to fruition, O'Brien notes. The expected intensity on costs just hasn't shown up yet. But here's where it gets controversial. Is this a failure of execution, or are shoppers simply loyal to cheaper alternatives that have already captured their wallets? On the employee front, Nadine Houghton, a national officer with the GMB union representing thousands of Asda staff, voices serious worries about the company's trajectory. Asda's owners at TDR Capital are yet again cashing in assets to tackle the debt mountain they themselves piled on through heavy borrowing, she says. With debts climbing, lease obligations surging, and interest costs ballooning, it's no wonder market share is tanking and worker spirits are at an all-time low. For beginners, this underscores how financial pressures at the top can ripple down, affecting job security and everyday morale in stores. Asda operates a vast network, 579 supermarkets, 517 express convenience outlets, and 29 Asda living spots for home goods and fashion. Rest assured, the 24 stores in this deal will keep running smoothly under Asda's management. The buyers? DTZ Investors and Blue Owl Capital, who now own the properties, but lease them back to the retailer. This transaction fits into a broader effort to tame the enormous debt stemming from the 2020 acquisition. Back then, billionaire brothers Mohsin and Zubair Issa, alongside private equity heavyweight TDR Capital, snapped up Asda for £6.8 billion in a deal loaded with leverage, meaning lots of borrowed money. Fast forward to now, TDR has taken full control after buying out Zubair, while Mohsin holds onto a 22% slice. It's a reminder of how private equity takeovers can supercharge growth, but also saddle companies with long-term burdens if sales don't soar. Credit analyst Amavir Singh at Credit Sites warns that this move could ding Asda's credit profile. Why? It ramps up reliance on leases, which count as liabilities, without channeling the funds into core investments or slashing primary debts. Instead, as the Financial Times first revealed, the money is earmarked to settle an obligation to Walmart, the American retail behemoth that once owned Asda and still owns 10%. Bond prices dipped on the news, signaling investor jitters. Subtly controversial here, some might argue paying off Walmart is housekeeping, but critics see it as prioritizing old ties over frontline recovery. What do you think? This isn't Asda's first rodeo with such tactics. In 2021, they sold off most warehouses for £1.7 billion. 2 years later, 25 supermarkets fetched £650 million. And in 2023, a quirky £300 million ground rent agreement rounded things out. Each time, the leaseback ensured continuity, but the pattern raises eyebrows about sustainability. An Asda spokesperson pushes back gracefully. Our property playbook focuses on bolstering a solid freehold foundation, while strategically tapping into our portfolio's value when it makes sense. These deals exemplify that balance. We cash in on the assets without losing our grip on operations. It's a professional spin, but does it convince you, or does it feel like putting a positive face on a pressing problem? Wrapping this up, Asda's story is a cautionary tale in retail resilience. Is this sale-leaseback a clever lifeline, or a band-aid on a sinking ship? Could bolder price wars finally turn the tide, or is the debt too deep? I'd love to hear your take. Do you shop at Asda, and does this make you rethink your loyalty? Drop your thoughts in the comments below. Let's spark a lively debate.